On Monday, November 25th, President-elect Donald Trump threatened Canada and Mexico with 25% tariffs on all goods as soon as he enters office. On Truth Social, Trump posted that, as everyone is aware, thousands of people are pouring through Mexico and Canada, bringing crime and drugs at levels never seen before. This tariff will remain in effect until such time as drugs, in particular fentanyl, and all illegal aliens stop this invasion of our country. In response to the news, the US dollar rose 1% against the Canadian dollar and 2% against the Mexican peso. The S&P 500 futures fell by 0.3%. Canadian Prime Minister Justin Trudeau said that he had a good call with Donald Trump to discuss tariffs and the future of Canadian-U.S. relations.
I had a good call with Donald Trump last night again. We obviously talked about laying out the facts, talking about how the intense and effective connections between our two countries flow back and forth. We talked about some of the challenges that we can work on together. It was a good call. This is something that we can do.
Meanwhile, Mexican President Claudia Sheinbaum suggested that her country would retaliate with tariffs of their own on U.S.-made products. Goldman Sachs warned that American consumers may face significant consequences in terms of costs if Trump proceeds with these tariffs. So what will the effect be of tariffs on the economy, and what's next for markets? We'll find out with our next guest, Matthew Piepenburg, partner of Greyerz AG. Good to see you, Matthew. Welcome back.
Always good to be with you, David. This time from London, not Switzerland, but it's always good to talk.
Markets are behaving a little bit erratically. Gold's going down. We'll talk about gold. Stocks have been euphoric since the Trump election victory. We'll take a look at this clip from the Mexican president who made an announcement. Take a listen to what she said about Trump tariffs.
A un arancel vendrá otro en respuesta. Y así hasta que pongamos en riesgo empresas comunes. Sí, comunes. Por ejemplo, de los principales exportadores de México a Estados Unidos son General Motors, Stellantis y Ford Motor Company, las cuales llegaron a México hace 80 años. ¿Por qué ponerle un impuesto que las ponga en riesgo? No es aceptable y causaría a Estados Unidos y a México inflación y pérdidas de empleo. El 70% de las armas ilegales incautadas a delincuentes en México proviene de su país. Las armas no las producimos nosotros. Las drogas sintéticas no las consumimos nosotros. Los muertos por la delincuencia para responder a la demanda de drogas de su país, lamentablemente, lo ponemos nosotros.
Inflation and job losses are the result of tariffs imposed. She's basically threatening tariffs on Mexican-produced U.S. goods. So, Is she right?
Well, listen, politics, as George Washington said, nations have neither permanent friends nor permanent enemies, just permanent interests. And obviously she has her own bias and Trump has his own bias. There's a lot of irony and paradox in there. I don't want to get too politically incorrect. There's a lot of things that Mexico does export to us that isn't quite good for us, but I don't want to get into a polarizing left versus right or Mexico versus U.S. debate. Clearly, there is an irony of imposing tariffs on products that are actually from American companies that harm supposedly American, companies like Ford, et cetera. I think what Trump is trying to do, and I'm not defending him, but I think the argument he's making and the reason for such policies, especially against Mexico, is his ultimate goal in making America great again, whether you buy it or not. His ultimate goal is to reshore production and companies and the C-suites and the manufacturing back to the U.S. And this is one way to kind of convince them, look, if you're going to produce out of Mexico, why don't you produce out of South Carolina or Detroit or Chicago, et cetera, or Illinois? It's a very bold statement. You can say many things, love or hate Trump. He does have an agenda this time around, much more clearly than he did in 2016. And he does tend to at least try to do what he says. And if he wants to make America great again and reshore productivity and manufacturing, whether that's through tariffs or whether that's through incentives, or whether that's through convincing the C-suite, which sold the American dream outside of America, primarily to China after the WTO in 2000, 2001, when we said, oh, great, China and all these other countries are going to be buyers of American blue jeans and products, when in fact they became manufacturers of American blue jeans and products. And Trump wants to reverse that. That was a C-suite executive decision because executives are paid on share prices. Labor is cheaper in El Salvador, Mexico, and in Asia. And so that wasn't necessarily Bill Clinton's fault entirely. It was also the billionaires on the S&P that wanted to have better share price salaries by outshoring labor. And I think what Trump is trying to do on the positive side of these tariffs is convince companies in the world that we're focusing on America, we're focusing on American productivity, American manufacturing, reshoring jobs. Again, all wonderful ideas. My argument is, and it's not to be anti-Trump or pro anything else, it's just that's expensive, and that takes more than one term. It's extremely bold. We could argue about tariffs all day long. I know with the new secretary, Treasury Secretary that he wants to bring in, he wants to be more selective with the tariffs and which countries, not just blanket tariffs across the board. And there's room to, quote unquote, make a deal, so to speak. Right now, Trump is doing what he does best, putting his chest out, puffing his chest out, making strong statements and getting strong reactions. But again, short and sweet, I think the ultimate goal is to bring productivity and manufacturing back to America. I can applaud the idea of that. I certainly think it's going to take longer than 4 years, and it's going to cost a lot of money. It's going to be very inflationary. And so there's a lot of things on his agenda that make a lot of sense, but frankly, I think are a little bit, wishful thinking without trying to be negative, because there's good intentions, but there's some reality we have to check out too.
I was going to ask you why you are applauding that idea, that ultimate goal, and you brought it up. It's inflationary. Even tariffs aside, if you bring manufacturing back home, I mean, the reason companies outsource is because there's labor cheaper abroad. You make labor more expensive. That's going to either decrease margins or make prices higher. So what are the pros here?
I'd rather see executive margins go down and more American jobs created. I mean, millions of jobs were lost in the Midwest where I'm from. I saw it with my own eyes when we, made the American dream in China many years ago. So I have no problem. I think the executive salary, the ratios from executive salaries to mid-level and medium employment or employees. My grandfather was at Ford during the McNamara era. At that time, the ratio of management to median employee ratio was 32-1, which was pretty high. Now it's 320-1. And in the case of Bezos, I've 7 or 8 times, it's 1.2 million to 1. So I think there's something psychopathic about that type of inequality in executive salaries and share price-based salaries. Certainly, I understand capitalism. I'm a capitalist. I would want to try and have the best labor policies I could and the best manufacturing advantages, but I wouldn't do that at the expense of millions of American jobs just so I could have 3 extra houses in Nantucket, Martha's Vineyard, and maybe somewhere out in the Caribbean. I think there's a point where it gets to be feudalism, not capitalism. I've argued that many times. I'm a capitalist, true and true. But the wealth inequality in America, the share price inflation in America, the combination of C-suite M&A deals that were ridiculous post-2008 and post-2020, the kind of executive wealth I see, the wealth inequality I see, the inflation in the NASDAQ and the S&P based on Fed policy, et cetera, that is not capitalism. That is Wall Street socialism, and I'm a capitalist. But I'm all in favor of trying to reshore jobs and bring manufacturing back to America. But that, again, is going to be expensive. Like many of Trump's plans, there's going to still be a lot of spending. And he has this Department of Government Efficiency with guys like Elon and Vivek that want to, cut 2 million jobs or 2 trillion worth of fat on the budget, by basically cutting 75% of the government jobs in DC, including the Department of Education. A lot of people would be happy with that. There's a lot of Soviet-like, Soviet era-like bureaucracy in DC that people want to see cut. If you can cut 2 trillion off the budget, that again optically looks great, probably gets a lot of support from people that are who aren't working for the government. But again, what happens to those people that are unemployed? How do you pay for that? Even if you can cut down some spending, you're going to be raising costs elsewhere. It's like you push here, you pull there. There's a lot of yes, but, yes, but with a lot of these ideas.
Before we continue with the video, let's talk about today's sponsor, Next Gold, a company on the path to becoming one of Canada's premier gold producers. Known for its strategic approach, Next Gold has built a solid foundation through smart acquisitions and backing from top investors like Sprott Asset Management. Their leadership team includes industry veterans with decades of experience in mine development. And their flagship project, the Goliath Gold Complex, includes 3 key sites with substantial reserves of both gold and silver. Located in a mining-friendly region, this complex benefits from essential infrastructure and includes about 65 kilometers of promising strike length with significant potential for gold mineralization. What truly sets Next Gold apart is its disciplined approach to growth and focus on creating value. If this sounds interesting to you, you can find Next Gold on the Toronto Stock Exchange under the ticker NEXG, or visit nextgold.com for more details. Link down below or scan the QR code here to learn more. Tariffs' effect on the economy, will it slow down growth, or will we have only certain sectors and certain products that may be imported less? So broad tariffs, will everybody be affected is my question.
I think everybody will be affected because obviously the price of goods coming in, because we're a major importer from a lot of products that were once made in America that have American labels that are now made in China and elsewhere. And those products are now going to cost more. That may incentivize some of those companies to reshore their labor back in the US. But if you want to talk about growth, David, I go back to David Hume in the 1750s. I go back to Reinhardt and Rogoff. I go back to von Mises. You can't get growth when your debt to GDP crosses the 110, 120% Rubicon. I mean, once you cross 100%, growth slows by 1/3. And the irony is, and again, I'm not trying to be anti-Trump, but if Trump wants to cut the fat and kill the swamp and drain the swamp, and if Vivek and Elon, want to cut trillions of dollars out of DC, there's a couple of things you got to keep in mind. All you got to do is reduce interest rates by 25 basis points, because every time you bring interest rates down by 25 basis points, that takes about 25 billion of expenses off the interest expense on our debt. So 25 billion in interest expense just by a 25 basis point cut is a lot easier than that many jobs you have to lose. You have to fire a lot of people in DC to come up with 25 billion. The monetary policy might be a fast way to do it. Again, I have nothing against cutting waste and fat in the swamp. But if you really want to go after the swamp, you got to go after Vanguard, State Street, BlackRock. You have to go after Big Pharma. You have to go after the K Street lobbyists. Ironically, crypto is the biggest lobbyist for Trump this year. If you really want to clean the swamp and you really want to get growth, you've got to cut waste, you've got to cut spending, you got to promote growth, but you can't promote growth with a debt to GDP this high. So it's a yes, but, yes, but. It's absolutely the craziest time I've ever seen in a macro setting. It's the craziest geopolitical scene. It's the craziest geoeconomic scene. But my long answer to your short question is, yes, tariffs will, I think, be inflationary. Reshoring jobs will be inflationary. I applaud them in some ways. I also applaud cutting fat in DC. But when you really want to get growth, someone has to sit down, someone who is not a former hedge fund manager at the Department of Treasury, which is still better than Yellen, anything is. But someone has to sit down, I think, like a von Mises, and sit down, or like a Javier Milei, and tell Trump, look, if you want to get growth, you got to cut the debt to GDP ratios. That takes more than 4 years. There's a lot of hype. There's a lot of hysteria. There's a lot of excitement. There's a lot of new cojones, so to speak, in DC right now. But I honestly think, and I'm not trying to rain on the parade of the excitement for Trump, but you can't get growth with this much debt. You simply can't.
So even if they cut the government size by 75%, which is what Vivek said, that's still not enough to bring the deficit down?
Again, it's great optics. It's very appealing, intuitively, instinctively. It appeals to me. But again, if you cut $2 trillion worth of jobs, then what happens to the U7, U3, U6 employment? What happens to the cost to keep those people on welfare for a year or on the dole for a year? Where do they find new jobs? And even if you do that, the cost of reshoring, the cost of these other great ideas are going to be more than the $2 trillion. I'm all for cutting spending in DC. I'm even for drastic cuts in the labor in the DC bureaucracy, but there's still a cost to that. You can't just eliminate those jobs without creating more costs. But something has to be done, and I agree. I'm not trying to just poo-poo every idea he has, but the truth is, that's one way. If you look, it's the 250th anniversary of America in 2 years, and Vivek and Elon want to cut it by $2 trillion. And believe me, no one can cut jobs like Elon. He can do it. And I think Vivek is a very smart guy. I think they can do it. If anyone can, they can. They're anti-government, they're anti-bureaucracy, they're anti-bureaucrat, and they are certainly businessmen. But again, macroeconomically, when it's like a guacamole game, you push here, something pops up there. If you cut those jobs, you eliminate that waste. In the long run, I think it's good. But you're going to also massively increase the unemployment levels, because a big part of our U3 or U6 employment is just jobs created in DC. When you start cutting those, again, those have costs, in my opinion. But again, I'm not against it. I'm just saying, let's be realistic. Let's slow down now after all this excitement and all this, hand-wringing from the left and all this excitement from the right. Let's come back down to reality. Trump wants to end the war. Great. He's got tariffs. He wants tax cuts. He's he's deregulation. He's going to be a spender. He's pro oil and gas. All these things I think are exciting, and they're at least a stance. We have a stance now. And I'm not against everything he says. I'm just saying, don't just look at the good. You got to look at the cost of these things. You got to look at the longer term. And I've said many times, I feel sorry for whoever gets elected in this recent election, because you're walking in to probably 36, 37 trillion by the time you're in the White House, whether that was Harris, Biden, or Trump. I've said kind of truculently that that's like becoming the captain of the Titanic after you've hit the iceberg. Again, the thing that no one talks about, whether it's here in London with the Labour and the Tories, or in DC with the left and the right during the campaigns, no one talked about the real elephant in the room, which isn't Republican, it's the debt. And anyone facing 36, 37 trillion in public debt doesn't have a lot of options. Trump is certainly going to blitzkrieg through there faster than anyone else. He's going to make big decisions. He's going to make big headlines. There's still going to be major costs. And I'm not trying to be negative for negative's sake. I'm just trying to be realistic in a nonpartisan way, if that's possible.
By the way, the tax cuts, will that worsen or help with the debt?
Well, it depends who you're talking to. I mean, I don't think the way out of a debt crisis is to tax more. The truth is, David, there is no easy way now when you're talking about this much debt. You can't, I don't think taxing the rich or taxing the middle class less or taxing the rich more, certainly that has optics, because I'm a big fan of the middle class. I truly am. I come from that world, from the Midwest. But we've seen over and over that doesn't lead to more growth. Historically, it just hasn't led to more growth. It just leads to more very wealthy people finding more and more clever lawyers, as Trump himself admitted, to get away from the taxes or find ways around the Internal Revenue Code. And that's what Trump admitted in his famous debate with Hillary Clinton. The wealthy will always figure out a way to get around these regulations. I don't think just tax up or tax down is going to stimulate growth. I think actually keeping taxes, he's promised to go back to the 2017 tax cuts and make those permanent. If anything, that could incentivize more speculation. It could incentivize more optimism, more tailwinds for a market that's already, as Jeremy Grantham says, grotesquely overvalued. But again, that goes into the conversation on the markets. But the markets aren't the economy. If spending went into manufacturing, if spending went into hiring labor in the U.S., I'd be all in favor of that. If it's just going to go into inflating a bigger and bigger S&P and NASDAQ bubble, I don't think that's going to help Main Street. Helps the 401ks. But the average family going to Costco trying to get groceries doesn't even have a 401k. They don't have an equity account versus a bond account to debate about. They don't have a Bitcoin account. They don't have a gold account. So, we've got to get back to the reality that I see in the Midwest that people don't see on the West Coast or the East Coast, that I see in Germany and Frankfurt that you don't see in Berlin. It's such a wealth divide in Europe and the U.S., but it's extreme in the U.S. But I think just taxes, just tariffs, it's a very complicated topic, but it really is, where's the spending going? Where's the cuts coming from? And will the spending just go into inflating the C-suites and more S&P inflation, or will it go into smart spending in the Rust Belts and in productivity and in hiring Americans for American jobs? I believe Trump wants to do that. Let's see if he can.
You said that this is the craziest time for the macroeconomic landscape, craziest time for geopolitics. We'll talk about geopolitics in just a minute. Take a look at my screen here. This is from The Economist October issue. The envy of the world, the U.S. dollar and the American economy. While you travel a lot, is that true?
Yeah.
Is the U.S. economy and the dollar the envy of the world?
Well, it is the best horse in the glue factory. Again, it's a tried cliche, but I've said it for years and I'll say it again. On a relative basis, there's nothing better than the U.S. dollar. If I were an American living in Argentina or living in Istanbul, I'd certainly prefer a dollar over a peso or a lira. But on a relative basis, there's no beating the dollar. It is king. On an individual basis, in isolation, it's still losing its purchasing power as we speak. It just is. The DXY is a 3-year high. It doesn't surprise me at all for a number of reasons right now. But again, it's yes, but. It's so crazy because even Trump wants a weaker dollar. His new Treasury Secretary wants a weaker dollar. He wants looser policy from the Fed, whether he tries to appoint a Fed chair or not. We don't want too strong a dollar. We don't want too high a yields. That makes our interest expense unpayable. It makes our exports more expensive. And even foreigners, this is the paradox. It's yes, but. Foreigners won't buy a U.S. Treasury unless there's a risk premium on it, unless there's a good yield. But at the same time, there's $14 trillion in dollar-denominated debt. If yields go too high, it gets too hard for foreigners to pay back the debt. So it's a constant paradox because we're in such a debt trap that whatever positive thing you can say about policy X has a negative thing about policy X. And you got to look at it in so many different ways. And yeah, the dollar getting too strong, I don't even think anyone, even Harris, didn't want a strong dollar Trump doesn't want a strong dollar.
Yeah.
The dollar debate, going, from Brent Johnson, who's always, the poor guy's always on the witness stand on this. I think there's no doubt, to his point, that there is a lot of demand for that dollar. It is the king of liquidity. It is what everyone spends with internationally. It's still king of SWIFT. We can talk about the petrodollar. It's still a big, big player. It's still the world reserve currency. It's not going away anytime soon. But there is this great sucking sound from the derivative market, from the eurodollar markets, and and frankly, from the oil markets. But what we're seeing is there's also a debate whether it's the eurodollar market creating demand, or whether the loss of love for the U.S. Treasury and the lack of love for the U.S. Treasury is actually going to hurt the dollar in the long run. So it's which happens first. But again, I'm not arguing for the end of the U.S. dollar, or the death of the U.S. dollar, or the end of the world reserve currency. I do think the forces in the oil markets, I do think the forces in the BRICS plus nations, I do think the forces in the unloved U.S. Treasuries, and the fact that the central banks in the East in particular are dumping U.S. Treasuries, that China and Japan are dumping U.S. Treasuries, all that adds a lot of supply. It pushes up yields. It could really affect, if there's less demand for the U.S. Treasury, there's going to have to be some way to create demand for that Treasury. That means we're going to have to print money to the moon to support the bond market that's unloved internationally. It's a constant set of paradoxes. If we keep seeing yields spiking because there's less and less demand for our IOUs, we're going to have to buy those IOUs ourselves. We can do it through indirect QE for only so long, through the short end of the curve, through the TGA, through the repo markets. But eventually, I believe we're going to hit that, mouse click button at the Eccles building and print money like we've never seen before. As Paul Tudor Jones said, the end game, all roads lead to inflation. And that's why we're trapped.
Is that what you're referring to in this article that you wrote? So you talked about this in a recent von Greyerz article. Well, we do know that change is certainly coming despite the DXY's impressive climb of relative strength. We'll talk about that in just a minute. Which does matter. We should expect to see a USD that trends weaker rather than stronger. Despite Powell's aborted higher for longer campaign of 2022-23, even Yellen and Sullivan have been operating openly and covertly toward a weaker dollar. How have they been doing this?
Well, there's so many backdoor QE methods that don't involve just the Fed adding zeros to the balance sheet over at the Eccles building. I mean, again, as I was trying to say, the most obvious, of course, is with the Treasury General account or with the reverse repo markets. You can create liquidity that way. You can issue more IOUs from the short end of the curve to take pressure off. And then, of course, there's the exemption from the supplementary leverage ratios, which I think will become actual at some point, where the too big to fail banks can effectively float a bond trade for the government, basically buy U.S. Treasuries for the Fed, and basically do the QE off the balance sheet of the Fed, become forced buyers of the Fed, and get a spread on the interest on excess reserves. It gets wonky math, but between supplementary leverage ratios, the reverse repo markets, the Treasury General account, and in these kind of wonky, complex mechanizations that go on in Wall Street and DC, there's been a lot of backdoor liquidity in ways around the Fed having to admit expanding its balance sheet as it's been doing QT and rate hikes for the last year and a half. But I think we're going to see QE to the moon at some point. But you've seen the reverse repo market lose liquidity at the same time the Fed was, reducing its balance sheet from 9 trillion to 7 trillion. Great victory, but that liquidity still had to come from somewhere, and those places are drying up. And, Luke Groman's did a great job of tracking this, but the liquidity has to come from somewhere because the economy is a debt-driven economy. That debt dries up real fast without oil. The engine dies, and that oil is mouse click money or false liquidity, which is inflationary, and it will either come directly from the Fed or from some of the force. But I think the only reason Powell's been reducing the balance sheet from 9 to 7 is so he has something to expand later. And the only reason he brought rates up was so he'd have something to reduce later, because he knows darn well that there's a recession. I think it's already here, but it's coming. He's going to need these tools. The only two tools he has is rates and balance sheet expansion, and rate cutting or rate rising. And it's so predictable. It's so freaking predictable.
Wait, the recession is coming. Are you still sticking to that?
Look, when we spoke in Vancouver, I said, we looked at the kind of classic indicators, the conference board indicators. We looked at the M2 money supply, the yield curve. But you recently had a guest on talking about the bankruptcies for companies over 100 million. It's at all-time high since 2020, but it's been 13-year peaks for small businesses that got crushed under higher for longer because they couldn't afford the higher rates and the debt rollovers. There's so many indicators: the credit card delinquencies, the credit card interest payments, the fact that manufacturing retail sales are flat. But if you get back past just these obvious, it's not data mining, it's data analysis. I'm not just trying to be negative for negative's sake. These are all the things that are ignored. If things were going so great for our soft landing economy, why was Powell reducing rates? Why at all? If we had beaten inflation, if it was a soft landing, and why did Harris have such a hard time getting elected then? Usually the incumbent does fine when the economy's fine, but I think people voted with their wallets again this year. And look, even the Department of Labor is revising its employment, new job projections for the whole year. The whole year is going to be revised down, negative, they're not going to beat their measures. They're going to be below. And that was the excuse Powell used all year to justify, well, we can afford to cut rates now because the economy's strong, labor is strong. That's empirically simply not true. And now the Department of Labor and Bureau of Labor Statistics are going to confirm that. They waited till after the election to admit that all those projections were, well, a little too, maybe too optimistic. So it's very political, but you can't fight the math, and you can't fight the fact that U6 unemployment is at 7%. That's a lagging indicator. It's going to be much higher, especially if they start cutting jobs in DC. So I'm just saying, what more evidence do you need of a hard landing than all those things, except for what? The S&P over 6,000 and the NASDAQ over 19,000? That is not the economy. That is a market. That is an inflated market. And we can talk about those markets, but that is not the economy. That is not going to save those poor families trying to struggle through each month's rent and going to Costco and who can't afford their car payments and are seeing record-breaking delinquencies in credit cards at rates no one should be charged. They're criminal. They're criminal rates.
So you think consumer spending might slow down next quarter? Is that possible?
But it depends on how much roulette they can play with their different credit cards, because that's what it's come down to for the America that I just drove through. When I went from Maine to the polo fields of Northern Virginia, that was all things are great, everything's fine. Then I went left, or I went west, and I drove back home. And I saw Pennsylvania, and Ohio, and Michigan, and Minnesota. It's not the same. It's not the same when you get away from Beverly Hills, Palm Beach, or if you get away from Park Avenue or Loudoun County, Virginia. Again, I'm not against people doing well. I'm not against a capitalistic society, but what we have this much wealth inequality and this much wealth concentrated into an inflated asset bubble, which is the S&P and the NASDAQ, which is the direct consequence of Greenspan, Yellen, Powell. I mean, they got progressively worse. Every Fed chair got worse from Greenspan, and he was the patient zero. But for someone like Powell to say that our policies on Constitution Ave have nothing to do with wealth or social inequality, that's an absolute farce. It has everything to do with it. It's the greatest wealth inequality in our history. It's the greatest stock bubble in our history. And I've benefited from that bubble, but it's gone too far this time. And you cannot say the economy is strong just because the markets are on a euphoric tear. And by the way, they can still go much higher. I'm not even that bearish yet on this insanity. That's why I think things are crazy, David.
Let's talk about markets now, starting with, what Vance and Trump want with the dollar. So we talked about your outlook for the dollar. Let's talk about their outlook for the dollar. The politicians want a lower dollar. They've been saying that since the summer, since they've been campaigning by picking Vance as his running mate. Donald Trump sent an unmistakable signal that should he return to the White House in January, weakening the U.S. dollar would be a policy priority. You know, it's interesting because when he was elected on election night, the dollar soared. What is the DXY? What was the DXY pricing in on November 5th?
It's a great question. By the way, when he was elected in 2016, gold retraced as well. The DXY went up and gold retraced. There's like the Trump rally, the Trump market, the Trump dollar, the strong America, the strong dollar. Look, I think in the near term, the DXY can go up. I've always said, like Goodluck, I see a trading range of the DXY between 100 and 110. I don't see it at 150 or at 70 either. This is the debate I've had with Brent Johnson. And I could be wrong, but I think in the near term, there is this sense that, that there is the trust that America is going to lead the world. It still leads the world despite all its warts and flaws. It's still America. Trump's going to do things strong for America. He's going to end the war in the Ukraine, which I actually hope and think he can. But I'm saying all this optimism and all this kind of flight to the dollar isn't a surprise. It happened last time, despite all the polarization and all the criticisms of Trump. But again, in the long run, and no matter what the DOGE or the Department of Government Efficiency does with cutting spending or cutting waste, there's going to be so much spending under Trump. And there's going to be so much need to support our bond market because of that $36 trillion in unloved IOUs and $36 trillion in debt and all the IOUs that have to be issued the next 4 years, that they're going to have to inflate their way out of this debt crisis. They're not going to grow their way out of it. That's my opinion. That's my negative, no fun at a cocktail party opinion. They're not going to grow their way out in 4 years. Just like the new captain can't save the Titanic after the iceberg. It doesn't mean it's the end of America. It's going to take longer than 4 years, and they're going to spend like drunken sailors to support the bond market, because every country, once it's over its skis in debt throughout history, without exception, has to choose between the bond market and the currency. And ultimately, they need to weaken the currency to support their bond market. And so Trump will get his wish, because he'll spend ad infinitum, as he should, to keep the markets and the bond markets alive and to keep these policies going. But that will weaken the dollar. And a weakening dollar is ironically an invisible tax on everyone, but it hurts the middle class the most. So again, it's yes, but, yes, but. It's crazy.
So you're saying what we should have is a stronger dollar that will help the middle class, but that's not what's happening.
Well, again, at this point, you can't. What we need, because there is a point where you've gone too far. There is a point you've had one too many lines of that dangerous drug, or one too many toxic drinks, or one too many drunken, trips down the road with one too many six packs under your seat. There's a point where you have to pay the piper. And there's a point where you have to be realistic, like Javier Milei can be in Argentina, because everybody is so on their knees. He can say it like it is. We still want to pretend that there's a way out of this. And that's why it's no fun to be around me. I'm not data mining to be negative. I'm not trying to be left or right, or just, for God's sakes, pro gold. That's not even the point. What I'm trying to say is, every nation throughout history, because this is much more about history and math than it is about gold, the DXY, spreads on the junk, and the triple C's and the triple B's, and all the wonky stuff we do on Wall Street. It comes down to being very simple. We have too much debt. The only way to help the middle class is to grow and give them jobs. It's going to take longer than 4 years, is all I'm saying. That's the only way out of this, and that's going to take a while.
What do you think is going to happen to gold on the subject of gold? Like you said, gold fell on the night of the election. Let's take a look at a gold chart right now. If you take a look at my screen, you'll see that gold topped out at almost $2,900. Yeah. And here we are at 26. There was a huge rally from its bottom in late November, basically a couple days ago, and it started going up. So it did recover some of its losses post the election. But what has been happening with gold?
There's a lot of ways to talk about gold, and I want to be very clear. I want to answer the question. But again, when you look at why I own gold or why I like gold, it has nothing to do. I never look at the daily price, the weekly price, even the monthly price. When you and I met in Vancouver, I think it was just above 2,000.
Yes.
This year it hit 2,700. I think of Russell Crowe, are you not entertained? Is that not good enough? Are you not entertained? And yet if it goes down to 26 or 2,500 for a week, or has an 8% retracement, everyone's poo-pooing gold and what? Chasing Nvidia and Bitcoin. So I don't want to just defend gold to defend gold, but I own gold because I know it holds its value far better than the peso, the yuan, the euro, the Swiss franc, or the dollar. But again, as to your specific question, it is important because there are a lot of people listening to this who are speculators, who are looking to get in and out of gold, or comparing it to things like Bitcoin, which to me is a false comparison. But yeah, I mean, the Trump market rally, when Trump was elected, that wasn't a surprise to a lot of people. I don't think it was even a big surprise to Wall Street. And I think there's a lot of optimism because Trump is going to make America great. Trump is going to reshore jobs. Trump is going to end the war in the Ukraine. That's what he's promising. And he does have a sincere interest in helping those people from Pennsylvania to Michigan, Ohio. So there's this optimism. And so when Trump came in, there was a hope. And so that fear, the fear of the war in Ukraine escalating, went down. The fear of America going into a debt spiral went down because a new Superman is in town. And so I think that clearly created a rally in the S&P and the NASDAQ, the opportunity cost, get out of gold and chase this rally like it did in 2016. I think the fact that yields are going up, that inflation is supposedly tamed, the narrative for gold is temporarily declined a little. You could argue that was it. Or if they have peace in the Ukraine, that'll bring the fear index down. That's less of a reason to hold gold. So those are things that can explain the temporary retracement in gold. And I'm certainly not saying that gold goes in a straight line. But you take all those factors that explain the gold, pullback, so to speak. But again, I have clients in 90 countries. Nobody called to ask about the gold price. No one cares because we buy it for 10, 30, 40 years. Now, for speculators, that's a different thing, and I respect that. But again, I look at gold 10, 20 years out, and I see it scares me how much confidence I have in gold because, look, it's really not about a gold bull market, David, and it's about what Peter Schiff said cryptically, but it's true. It's about a fiat money bear market. By the way, it's the same narrative that Bitcoin is exploiting beautifully, brilliantly. But the truth is, gold isn't ripping because gold is suddenly more shiny. Gold is ripping because fiat money, including the world reserve currency, has nowhere to go but inflationarily debased to solve the debt crisis, short of a big Bretton Woods 2.0 or Plaza Accords 3.0. and a grand big restructuring, which even that would still be so disruptive. But I'm saying it's just track the direction of the hockey puck. Money has to be debased to subsidize and monetize the credit markets, which are the rotten wind beneath the so-called GDP and growth that we have in America and in the world. And it's a global problem. And then you add on the other factors like de-dollarization. It's not just a bogus headline. It's forgotten now with the Bitcoin hype and the Bitcoin reserve, American reserve Bitcoin accounts and all that. There's a lot of hype right now. Yes, but strip away all the fog, keep your eyes on the lighthouse, and paper money is just losing its value. So gold will continue to go cyclically higher. We can talk about whether it gets revalued to help pay down some of the debt. Those are all pie in the sky notions that would send gold to record incredible highs overnight. But again, I'm not even worried about that. I'm looking 10, 20 years out, and that's too boring, understandably, for the speculators watching, which I came of age as a speculator. I don't make fun of it. I don't make fun of those that are chasing Bitcoin and comparing it to gold. I'm not here to mock that. I was in Frankfurt 2 weeks ago with a young guy, younger than me, who bought Bitcoin at 400. I sat back. I was so happy for him. Mostly I was jealous. But even he and I admitted we got to figure out what to do with that Bitcoin money because he knows it's a lottery ticket, just like my IPO was in the dot-com bubble. Well, I knew it was. I never confused that with intelligence. I wish I bought Bitcoin at 400, but knowing me, I would have probably sold it 1,000 because I could never imagine this. So I'm not here to make fun of Bitcoin or the people who have done well. I'm happy for them. But I'll be honest, as we say, unter vier Augen, but just among us, when I talk to my investors who are Bitcoin millionaires, they know what it is.
That's an interesting point. If you had bought Bitcoin at 400, you probably would have sold it at 1,000. Okay, I think most of us would. But you look at Bitcoin as a speculative asset, which a lot of people do. That makes a lot of sense. Would you have sold gold at 1,000 if you had bought it at 400?
No, because I personally look at gold very, very differently. And that's how my clients look at gold. So it's a very different conversation. And Grant Williams says this better than me. If you're an investor and owner rather than a renter of gold, if you're looking at your kids' wealth and the legacy of money you've already made, whether it was lucky like me on a pre-IPO, or whether it's lucky like a lot of my friends in Bitcoin, or whether it was hard-earned, or whatever it is, when you have wealth, you can decide, do you want to take a risk to grow it? God bless you. Or do you want to preserve what you have? And that's God bless you on that too. So it's two very different mentalities. It's not smart versus stupid, right versus wrong. It's two very different uses. And when you understand the historical direction of fiat money, which always goes to zero at some version, it always gets debased to monetize debt. I'm just a wealth preservation guy. That is so boring compared to the narrative. Look, if you look at Bitcoin, it absolutely outperforms gold as a performance asset. Are you kidding? You can't even compare. It outperforms everything. But again, Bitcoin, it changes every day. But when I was a family office guy and I was investing in hedge funds, I looked at hundreds of hedge funds. I looked at three things: their annualized return, their maximum drawdown, and their standard deviation. Bitcoin has an annualized return of way over 70% because in 1 year it was up 5,000%. That was in 2013. So it has an annualized return, which is off the charts, fantastic. It has a maximum drawdown of over 80%, 4 times. And it has a standard deviation of above 170. And you can play with the numbers, but you get my point. With that type of maximum drawdown standard deviation, you cannot even come close to comparing that to gold or as a store of value. That narrative just doesn't float. Doesn't mean I'm against Bitcoin for speculation and where it can go. But please stop calling it digital gold. It's just not. And it's not to be anti-Bitcoin. It just doesn't preserve. It doesn't store value. It's not a unit of exchange. It's not a medium of exchange. You can at least say that gold was once money, and it's certainly being stacked by central banks in the East because it's being used as a store of value and a medium of exchange to net settle oil deals between China and Russia. So gold is money, and gold is a preservation asset. It is a store of value. Bitcoin is the speculation asset of a generation, and I have nothing against that. But please call it what it is. That's all I'm saying.
I like talking about gold with you because there's so many different forces. It's not just the ultimate gold price that I'm concerned about as a journalist. I like talking about the different macro variables that control or impact gold. And one of them is geopolitics. So let's talk about geopolitics now. You mentioned this is the craziest time for geopolitics. Now, I don't know, but I suspect that the recent drop in gold from just 2 days ago could be because there was a ceasefire brokered in Lebanon. Take a look at my screen here. This is ceasefire agreed by Israeli and Lebanese leaders. This is taking effect yesterday. Under the U.S. brokered agreement, Israeli forces will gradually withdraw from Lebanon over 60 days and be replaced by the Lebanese army. So the Trump said he wants peace in the Middle East. Trump said he wants to end the war in Ukraine on day one. Let's see if he actually does it. But are the markets sniffing out this possibility of peace and less geopolitical instability, which could be a bearish case for gold if you just take a look at geopolitical premium? What do you think?
I absolutely agree. And I have no problem with that. And it doesn't surprise me at all. If you can create peace in the Middle East and you can end the war in the Ukraine, he should get the Nobel Peace Prize for that. Cut the crap. That's a fantastic thing. If he can actually pull it off, and I think he certainly has Putin's ear far better than the Harris and Biden administration. And I don't want to get into that very polarized debate, but I was completely against the sanctions, as many of us were. It has nothing to do with being pro-Putin or anti-American. But I think this was a proxy war on the back of a lot of sadly dead Ukrainian and Russian soldiers that could have been avoided. That being said, the idea that Putin and Trump can hopefully reach a peaceful agreement before we escalate, before he comes into the White House, would be fantastic for the world. It would probably be bad for gold, which I have no problem with. Because again, I hold gold 10, 20 years out. I'm not worried about a $200 or $300 or 5 or 10% retracement if I'm holding gold for the long term. If you're trying to trade gold, and believe me, that's a very hard asset to trade. I would be very careful. But again, if you're good at it, if you know what you're doing, fantastic. If you know how to look at the certain indicators, that's fantastic. I'm nothing against it. I'm just not a trader. I'm not a renter of gold. I'm an owner. So it's a very different answer. But yeah, absolutely. If we have peace in the Middle East, of course the gold price is going to go down. But ultimately and eventually, the gold price is going to go up because every country in the world is in debt up to its nose, and it will debase its currency. And that's why it's such a crazy world, Dave. I mean, even China, look, China from the 1990s to 2000 was 40% of global growth. Now its debt to GDP, and GDP numbers are almost as bad, if not worse, than America. 60% of its groundwater is rotten. Its demographics are horrible. It has to import its food and its energy. And let's not forget the fact that, look, right now, China is having a major banking crisis, financial crisis, and when they're no longer the engine, they're no longer the buyer of last resort or first resort. Remember years ago, GDP for China was up every year, 8% automatically. It was like concocted on an algorithm. But again, when China catches a cold now, the world gets sick too. So you have, it's very complex. It's yes, but. But right now, I'm in Europe. Look, the PMIs out of Germany are horrible. The PMIs out of France are horrible. They're not even that great in America. China's in recession. Germany's in recession. The UK, in my opinion, is in recession. France is barely hanging on. The US is still the best horse in the glue factory, but it's over its skis in debt. All these countries share the same disease. They're over their skis in debt. They're going to debase their currency. In the long run, that means gold goes up. Because currencies go down. But again, to your point, geopolitics, peace in the Middle East, peace in Ukraine, absolutely is going to be a headwind for gold.
We have to remember it's not just the Middle East and the Ukraine that have hot spots, right? You said this is the craziest time for geopolitics right now. What do you mean by that? Can you elaborate?
Well, pick almost any spot on the global map. Look at the South China Sea. Look at how that red line's getting fatter and fatter. Look at the bases surrounding China. You know, I was just in a conference where a really bright guy, Clem Chambers, who was a writer during the dot-com bubble when I was trading for Wired and then worked for Fortune and is a brilliant, very successful gold and Bitcoin investor. He lives in Monaco. He's obviously done well. He gave a fantastic presentation about gold is war. Whether you're actually at war or not, gold is a national security asset because in times of war, gold is the only asset that works if everything breaks down. And he didn't say, I hope we have war that expands in China, or I hope we have war that expands in the Middle East or in the Ukraine. But he says just the tension, for which there's no end in sight, creates a need for gold. And it's one of the many other reasons that the BRICS Plus nations and the UAE and Saudi are stacking gold. Again, it's not a gold bug case. It's history. It's common sense. And I hope it never escalates to a hot war. Just the tension alone, though, he made an argument for, which I'd never really thought about. But I think there will be moves up and down. Believe me, anyone who says they know the price of gold next week is a liar. And anyone who says gold or silver goes in a straight line is a liar. Of course it isn't going to go in a straight line. But secularly, historically, it only goes up because paper money only goes down. I see no way around that in the near or distant future. And I don't see Bitcoin, again, not to be anti-Bitcoin, it wasn't yesterday, it isn't today, and it won't be tomorrow a store of value. Not at all. But it is a speculation asset, which I wish I had the courage to have bought a long time ago and figured out a long time ago. But again, separate speculation from store of value. We shouldn't be fighting each other about Bitcoin versus gold, but we should stop comparing the two. It's just not digital gold. It's not.
Yeah. Let's finish off on monetary policy. You said earlier in the interview you could expect at some point the Fed to re-engage with QE. Walk us through that road.
Well, it's like everything else. You'll have the signal will be when our treasury auctions start to really fail, when it gets really, really embarrassing. Again, it's not me making this up as a gold bug. Try and get the gold thing out of the conversation. Just look at what the world's doing. Again, I'll say it again and again. Long before it became obvious when we weaponized the US dollar in 2022 and the de-dollarization started, way back in 2014, the world recognized that America was getting too fat in debt. It was losing credibility. It wasn't the prettiest girl at the dance anymore. It kind of had some blemishes. The fat was getting fatter. The debt was getting bigger. And so by 2014, we started seeing a net sell-off in US treasuries and a net buying of physical gold. That became more and more extreme after the weaponization of the dollar against of the ruble, et cetera. But, that genie doesn't go back in the bottle. So, we can't deny that the simple fact is that the U.S. Treasury, because there's so much debt and because it's been weaponized, those two things in combination have made it less loved. And if it's less loved, and we still spend far more than we take in tax receipts and GDP, and 1/2 of our 3% GDP growth was purely based on stimulus. If you look at even the Fed's beige book, that 1.5% of that 3% was household and business. The rest was just debt. Debt-based growth isn't growth. So we're not going to grow our way out of this. We're going to spend ad infinitum. That's what every politician does, left or right, including Trump. If you look back at his record, it's not any better than Biden's. You can break it down. But the truth is, we're going to spend more than we bring in GDP and tax receipts in the near term. I hope we get growth over the next 15, 20 years. It's going to take more than one term. But because we're going to spend more than we bring in, and because we're going to have to issue more IOUs, more U.S. treasuries, and because the world loves them less, someone or something has to buy those U.S. treasuries. And that thing is called the Fed. And that is called QE. And even Biden's chief economic advisor couldn't even describe what QE was. That's how scary it is when you have mental midgets running our economy. I don't know if Trump is or isn't. He's certainly a businessman. Does he understand macroeconomics? Does Bessons? We'll find out. I mean, he's a pretty smart guy. Worked with Soros and Jim Rogers. I think he does. I think Trump has a very smart team. If anyone can do it, it's going to be him starting it, but he's not going to be able to do it in 4 years. I think we have to have our expectations realistic. And again, we are issuing an IOU that the world does not trust as much and does not believe in as much because of our debt. And so we will print to the moon at some point, and that will be inherently inflationary. And deficits are inherently inflationary. And inflation just means the lower purchasing power of your currency. And that's why gold shines, not because it does anything better. It just holds its value better than paper money. Always has, always will. And that's the direction I see. That shouldn't be gold bug. That's math and history.
Okay, very good. Thank you very much. I appreciate you joining the program while you're traveling. Matthew, where can we learn from you and von Greyerz?
Yeah, well, von Greyerz.gold or Gold Switzerland as always. My articles and Egon's articles are out there and interviews are posted there. And, again, all our different viewpoints, historical on gold going back many years, and other free articles just on jurisdictional choices to own gold, how to hold it, where not to hold it, gold versus, paper gold like ETF versus physical. All that stuff's there for free. You don't have to be a client to get educated on it. And I'm gonna come up with an article on Bitcoin and gold. Again, not to attack Bitcoin. I don't want to pick a fight. Larry Lepard is brilliant. Ronnie Sturfill are brilliant. They're in the Bitcoin play. I get it. Just understand the different roles. That's all I'm saying.
Good. All right. We'll put the link down below. So make sure to follow Matthew there. And you write a lot of good articles for von Greyerz. So I encourage you to check out your blogs. Thank you for joining us once more. And thank you for watching. Don't forget to like and subscribe.